Rule number 1 is never lose money. Rule number 2 is never forget. Rule number 1. This is perhaps the most quoted and simultaneously the most misunderstood piece of advice in the entire financial world. When Warren Buffett says never lose money, he is not living in a fantasy world where stocks only go up. He is perfectly aware that in the short term, the market is a voting machine and stock prices will fluctuate wildly. What he is referring to is the permanent loss of capital. He means you must structure your investments in such a way that an unrecoverable disaster is mathematically minimized. The cornerstone of this philosophy is a concept he learned from his mentor, Benjamin Graham, at Columbia University. It is called the margin of safety. To understand the margin of safety, you have to understand the difference between price and value. Price is what you pay. Value is what you get. If you calculate that a business will generate a certain amount of cash over its lifetime, you can discount that cash back to today and find its true intrinsic value. Let us say you do the math and determine a company is intrinsically worth $100 per share. If the stock is currently trading at $95, you might think you have found a deal. But Buffett would likely walk away. The gap is too small. If your calculations are slightly wrong, or if the economy goes into a recession, or if the management makes a foolish acquisition, that $5 discount will vanish instantly. You have no margin of safety. But if the market panics and prices that same $100 stock at $50, now you have a massive margin of safety. You are buying $1 for 50 cents. Even if the company hits a rough patch, your downside is severely limited because the asset is inherently worth so much more than your purchase price. Let us look at a real-world application. In 1973, the stock market was suffering through a brutal bear market. The Washington Post Company was publicly traded, and the market valued the entire enterprise at around $80 million. Buffett looked at the underlying assets. The company owned a dominant newspaper, highly profitable television stations, and magazines. He calculated that if you sold off the assets to private buyers, the company was easily worth $400 million. The market was offering him a chance to buy a slice of a $400 million pie for the price of an $80 million pie. The margin of safety was so overwhelming that Buffett did not need to predict the future of the economy. He just had to buy and wait for the market to realize its mistake. Over the decades, that investment grew into the billions. Protecting your wealth does not require predicting the future. It requires demanding a heavy discount on the present. You insulate yourself from your own mistakes and the market's irrationality by refusing to pay full price for any asset. In the late 1990s, the financial world lost its collective mind. The dot-com bubble was inflating at a terrifying speed. Companies that had never turned a profit, and in some cases had absolutely zero revenue, were going public and watching their valuations soar into the billions simply because they added a .com to their name. Day traders were quitting their steady jobs to trade technology stocks from their living rooms, making millions of dollars on paper in a matter of weeks. Everyone was getting incredibly rich. Everyone, that is, except Warren Buffett. The financial media turned on him aggressively. In December 1999, the respected financial magazine Barron's published a famous cover story with the headline, "What is Wrong, Warren?" They essentially called him a dinosaur who had lost his touch, a relic of an old economy who completely failed to grasp the new paradigm of the internet age. But Buffett was not bothered by the noise. He simply leaned back and invoked his second rule of wealth protection: stay strictly within your circle of competence. Buffett openly admitted to his shareholders that he did not understand how these internet companies were going to make real money a decade into the future. He could not predict who the definitive winners and losers would be in this chaotic new technological frontier. He knew banking intimately. He knew insurance inside and out. He knew consumer goods like Coca-Cola and Gillette. He knew furniture and jewelry. He did not know microchips, web portals, or e-commerce software. So he sat on his hands. He watched other people get incredibly wealthy on paper, and he did absolutely nothing. This is arguably one of the hardest psychological tests for any investor to pass, to sit quietly and do nothing while your neighbors are seemingly getting rich overnight. But Buffett understands that the overall size of your circle of competence is not very important. What is absolutely critical is knowing exactly where the perimeter of that circle is, and having the extreme discipline to never, ever step outside of it. When you invest outside your circle of competence, you are no longer investing. You are gambling. You are relying on blind hope, market momentum, and the greater fool theory, which states that someone else will eventually buy the stock from you at an even higher price later. When the dot-com bubble inevitably burst in the early 2000s, wiping out trillions of dollars of wealth and completely destroying the portfolios of the very people who had mocked him, the dinosaur was the only one left standing fully intact. To protect your wealth, you must identify what you truly understand. If a business model is too complex, or if its future cash flows are too difficult to predict with any certainty, put it in the too hard pile and move on. There are tens of thousands of publicly traded companies in the world. You only need to truly understand a small handful of them to become extraordinarily wealthy and keep that wealth safe. Most amateur investors spend their time looking at stock charts, obsessing over moving averages, momentum indicators, and the daily noise of the financial news cycle. Warren Buffett ignores almost all of that completely. He famously spends up to 80% of his working day sitting alone in his quiet office in Omaha, just reading. But he is not reading Wall Street analysts' predictions or macroeconomic forecasts about what the Federal Reserve will do with interest rates. He is reading the real language of business, which is accounting and financial statements. To truly protect your wealth in the markets, you have to understand exactly where the numbers come from and what they mean. When Buffett looks at a company's income statement, he is not just glancing at the bottom line to see if they made a profit that quarter. He is acting like a forensic detective hunting for an economic moat. An economic moat is a durable competitive advantage that protects a company's profits from its competitors, much like a physical body of water protects a medieval castle from invaders. He starts by looking straight at the gross margins. If a company consistently maintains a gross profit margin above 40% over a period of many years, it tells him a crucial story. It tells him the company has extreme pricing power. Consumers love the product or service so much that they are willing to pay a premium for it, and the company does not have to engage in destructive price wars with competitors just to survive. But a high gross margin is only the beginning of the investigation. Buffett then moves down the income statement to the operating expenses, specifically looking at selling, general, and administrative expenses, as well as research and development. A truly wonderful business does not need to constantly drain its operating profits into massive research and development budgets just to stay relevant in its industry. If a company has to constantly reinvent its flagship product every 2 years to avoid going bankrupt, that is a highly fragile enterprise, not a safe place to park your wealth. He also closely examines the capital expenditures. Does the company need to spend billions of dollars constantly upgrading its factories, machinery, and equipment just to maintain its current earning power? Buffett absolutely hates capital-intensive businesses. He looks for companies that can rapidly grow their earnings while requiring very little additional capital investment to do so. Furthermore, Buffett absolutely despises the metric known as EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. Wall Street bankers love to use EBITDA to make a highly leveraged company look much more profitable than it actually is. Buffett considers this metric highly deceptive and dangerous because it entirely ignores depreciation. As he once famously asked his shareholders, "Does management think the tooth fairy pays for capital expenditures?" Depreciation is a very real expense, representing the real wear and tear on physical assets that will eventually have to be replaced with real cash. By meticulously dissecting the income statement, the balance sheet, and the cash flow statement, Buffett separates the fragile companies from the financial fortresses. If you cannot read the accounting, you are flying blind in a storm, completely vulnerable to corporate manipulation. The stock market is essentially a manic-depressive machine. Warren Buffett's mentor, Ben Graham, perfectly personified the stock market as a highly emotional business partner named Mr. Market. Every single day, Mr. Market knocks on your front door and offers to buy your share of the business or sell you his share. The catch is that Mr. Market is deeply emotionally unstable. When things are going well in the economy, he is wildly optimistic and euphoric, and he demands an unbelievably high price for his shares. When the news is bad, he becomes terribly depressed, panicked, and is willing to sell you his shares for pennies on the dollar. Buffett's fourth rule is perhaps his most famous quote, and it is a direct exploitation of this manic-depressive behavior. Be fearful when others are greedy, and be greedy when others are fearful. Protecting and exponentially growing your wealth means aggressively fighting human nature. It requires a tremendous amount of emotional discipline to deliberately move in the exact opposite direction of the panicked herd. Let us look at the catastrophic global financial crisis of 2008. The American housing market had entirely collapsed. Global credit markets froze completely solid, and the world economy was literally on the brink of total failure. Major financial institutions that had existed for over a century were filing for bankruptcy overnight. Wall Street was absolutely terrified. Liquidity completely dried up, and nobody wanted to lend a single dollar to anyone. While ordinary investors were watching their life savings evaporate on their computer screens and were panic selling their portfolios at rock-bottom prices to stop the bleeding, Warren Buffett opened his massive checkbook. He calmly stepped into the absolute chaos and invested billions of dollars into blue-chip companies like Goldman Sachs, General Electric, and later Bank of America. Because he was one of the only people in the entire world with massive amounts of cash on hand and the psychological courage to deploy it, he was able to demand incredibly favorable terms that no regular investor could ever get. For instance, his $5 billion investment in Goldman Sachs came in the form of preferred stock that paid a guaranteed 10% dividend, plus warrants to buy common stock later at a fixed, deeply discounted price. He did not do this out of charity. He did it because the blind fear in the market had driven the prices of these fundamentally essential American institutions down to irrationally cheap levels. The human brain is actually hardwired through evolution to feel the pain of financial loss much more intensely than the pleasure of financial gain. When you see your portfolio bleeding red, your amygdala triggers a primal fight-or-flight response, urging you to sell everything and run to the safety of cash. Buffett has trained his mind to completely override this biological response. He views market crashes not as a tragedy, but as a clearance sale at his favorite store. He understands that bad macroeconomic news is a value investor's absolute best friend. If you can keep a cool head when everyone around you is losing theirs, a severe market panic will provide you with the greatest wealth-building opportunities of your entire lifetime. In the early years of his investing career, Warren Buffett was strictly a value investor in the most traditional, old-school sense. He practiced something he colorfully called cigar butt investing. He would scour the financial markets looking for terrible, dying, mediocre companies that were trading at such absurdly cheap prices that there was still one free puff of profit left in them. If you pick up a discarded cigar butt off the street, it is ugly, it is soggy, and it is disgusting. But if it is completely free, that one last puff is pure profit. He would buy these deeply distressed companies, wait for a slight price bump in the market, sell them off, and quickly move on to the next one. While this strategy absolutely worked and successfully made him a millionaire, it was a highly stressful, exhausting, and ultimately unscalable way to manage large amounts of wealth. It often required hostile takeovers, liquidating businesses, firing employees, and constantly searching the bottom of the barrel for new, heavily discounted targets. It was his longtime business partner, the brilliant Charlie Munger, who forcefully pushed Buffett to completely evolve his thinking. Munger convinced him of rule number 5. It is far better to buy a wonderful business at a fair price than a fair business at a wonderful price. The definitive turning point for this new philosophy happened in 1972 when Berkshire Hathaway purchased See's Candies. See's Candies was absolutely not a cigar butt. It was not trading at a massive discount to its book value. In fact, the owners wanted $25 million for the company, which Buffett initially thought was outrageously high for a business that only had about $8 million in tangible, physical assets. But Charlie Munger pointed out the invisible assets. See's Candies had an incredible, unbreakable brand loyalty on the West Coast. People associated the candy with holidays, romance, and family happiness. Because of this powerful emotional connection, the company could raise its prices every single year without losing any customers to cheaper competitors. Furthermore, making boxed candy is a relatively simple manufacturing process that did not require massive amounts of continuous capital investment to maintain or grow. Buffett swallowed his deep-seated pride as a bargain hunter and bought the company. Over the next several decades, See's Candies generated well over $2 billion in surplus cash for Berkshire Hathaway. That is $2 billion of completely free cash flow that Buffett then used to go out and buy other, massive, wonderful businesses like Geico Insurance and Coca-Cola. A wonderful business fundamentally protects your wealth because it acts as an inflation-proof compounding machine. If extreme inflation strikes the economy and the cost of sugar, cocoa, and packaging goes up, See's Candies simply raises the retail price of their box of chocolates. The loyal consumer willingly pays the higher price, and the company's profit margins remain perfectly intact. A mediocre, commodity-based business cannot do that. If they dare to raise their prices, their customers will immediately flee to a cheaper alternative. Transitioning from buying cheap, bad businesses to buying fair-priced, wonderful businesses was the exact catalyst that turned Warren Buffett from a successful millionaire into a legendary multi-billionaire. Rule 6. Let compounding do the heavy lifting forever. The entire structure of Wall Street and the modern financial industry is meticulously designed to make money when you take action. Brokers, trading platforms, investment banks, and actively managed mutual funds want you buying, selling, reacting to the latest breaking news, frantically shifting your portfolio allocations, and paying expensive commissions and management fees every single time you make a move. Warren Buffett's strategy is the exact and polar opposite of this frenetic activity. His famously stated favorite holding period for a wonderful stock is forever. This brings us to rule number 6. Let compound interest do the heavy lifting, and never interrupt it unnecessarily. Every single time you sell a stock to lock in a profit, 2 very bad things happen to your wealth. First, the government immediately steps in and takes a significant cut of your money through capital gains taxes. Second, and much more importantly, you completely interrupt the mathematical miracle of compounding. Buffett protects his wealth by brutally refusing to interrupt the compounding process. If you have done your rigorous homework and you own a piece of a wonderful business that is run by honest, extremely competent management, and that business continues to reliably grow its earnings year after year, why on earth would you ever want to sell it? Trading in and out of the stock market to try and catch short-term pricing swings is a fool's errand that mostly just enriches your broker. Look very closely at the trajectory of Warren Buffett's personal wealth over his lifetime. Today, he is a centimillionaire, widely recognized as one of the wealthiest humans to ever walk the earth. But the specific timeline of how that wealth was accumulated is what is truly astonishing. He made his first $1 million around age 30. He reached his first $1 billion around age 56. But over 90% of his current massive net worth was accumulated entirely after his 65th birthday. Let that profound fact sink in for a moment. The vast, overwhelming majority of his monumental fortune was generated when he was already at traditional retirement age. That is not because he suddenly became a profoundly better investor in his 60s and 70s. That is simply the relentless, exponential, unstoppable mathematical reality of compound interest operating over a very long period of time. It is money making money, and then that new money making even more money, ad infinitum. At his conglomerate, Berkshire Hathaway, Buffett famously refuses to pay a dividend to his shareholders. He firmly believes that if he keeps the cash inside the company, he can personally reinvest it at a much higher rate of return than the individual shareholders could ever achieve on their own. He uses the massive profits from his existing companies to buy more great companies, which then generate even more profits, which buy even more companies. It is a massive financial snowball rolling down an endless hill, gathering speed and size with every rotation. Inactivity in the stock market is frequently viewed by amateurs as a sign of laziness or a lack of edge. To Buffett, strategic inactivity is a highly calculated, ruthlessly aggressive strategy to avoid the friction of taxes and fees. As he has astutely noted, the stock market is essentially a highly efficient mechanism for transferring wealth from the impatient to the patient. You can spend years mastering the complex intricacies of corporate income statements and balance sheets. You can patiently wait decades for the perfect margin of safety to appear during a market panic, and you can buy wonderful, cash-flowing businesses and hold them tightly for half a century. But according to Warren Buffett himself, the absolute ultimate rule to protect and preserve your wealth has absolutely nothing to do with the stock market, commercial real estate, or complex financial instruments. During severe periods of runaway high inflation, fiat currency rapidly loses its purchasing power. During severe economic depressions, real estate values can absolutely plummet. During sharp recessions, well-diversified stock portfolios can be cut in half in a matter of months. But there is one specific, highly unique asset that is entirely crash-proof, completely inflation-proof, and 100% tax-free: your own personal earning power. Rule number 7 is that the greatest, highest-yielding investment you can ever possibly make is an investment in yourself. Buffett constantly emphasizes this golden rule to university students, young professionals, and seasoned executives alike. If you are the absolute best cardiovascular surgeon, the most brilliant software engineer, the most creative architect, or the most highly persuasive communicator in your city, you will always command a premium price for your services. People will always be willing to give you a significant portion of what they produce in exchange for what you do best. No government authority can tax your internal skills, and no thief in the night can steal your accumulated talents. When Warren Buffett was a very young man, he was utterly and completely terrified of public speaking. He physically shook when he had to stand up in front of a room of people, but he knew that if he could not communicate his complex ideas effectively to others, his brilliant financial mind would ultimately go to waste. He saw a newspaper advertisement for a Dale Carnegie public speaking course that cost $100. He was so incredibly nervous that he actually dropped out before the first class even began. But he eventually forced himself to go back, pay the $100 in cash, and complete the grueling course. To this very day, if you are lucky enough to walk into Warren Buffett's personal office in Omaha, Nebraska, you will not see his prestigious undergraduate degree from the University of Nebraska hanging on the wall. You will not see his master's degree from Columbia University hanging on the wall. The single solitary diploma proudly displayed in his office is that $100 paper certificate from the Dale Carnegie public speaking course. He credits that single course with fundamentally changing the entire trajectory of his life, because it gave him the crucial ability to convince people to trust him with their money and their businesses. You must constantly strive to develop your own skills, read extensively and exhaustively. Buffett famously reads 500 pages a day, treating accumulated knowledge exactly like compound interest that builds up massively over time. Actively improve your written and verbal communication. Cultivate a rare talent or a highly specialized skill set that is so extraordinarily valuable, the broader economy has absolutely no choice but to richly reward you, no matter what the stock market is doing on any given day, no matter what the Federal Reserve is doing with interest rates, and no matter who is currently sitting in the White House. Your financial wealth is ultimately a direct reflection of the unique value you consistently provide to the world. So you must absolutely make sure that you are the single most valuable, irreplaceable asset in your entire portfolio.